Hello and welcome back to the channel. So today I want to show you an earnings strategy. This is actually an after earnings strategy that I've used quite often, and it's worked really well for me. So the strategy is you want to find a stock that has just released earnings and has gapped down. What I've found, and not all the time, but quite often, um, after earnings, when a stock gaps down, it'll trade flat for a while. And we can see that Intel last year did this twice in a row. Back in mid-July, it gapped down, traded flat. Then again in October, it gapped down and then traded flat. Now, obviously, before you enter a position, you should look at the news and just see if it was an overreaction or if it's actually really bad news for the company. Now, the best way that I've found to implement or enter this strategy is to either sell a a put spread somewhere at the 30 delta or below, and I'll normally do like a $5 wide spread. So that gives an 84-cent credit. Now this stock actually hasn't had earnings yet, so after earnings we'll see what it does. But if we want to create a scan to find stocks that this has happened to, I already have one created right here. We scan in weeklies. It's just 3 study filters, 2 of them earnings and 1 of them a price change. We want to have earnings, does not have earnings anytime in the next 50 bars. And then we want earnings, has earnings anytime in the next 100 bars. And then we want to look for a price change at least 8% less than 10 bars ago. So that's 10 trading days. And if we scan, we can see that we've got roughly 6 stocks it has brought up. We'll look at Netflix. And we can see that Netflix just had an earnings announcement and it has dropped. I think it's a little bit over 8%. Something else I'll add is I like to wait roughly 5 to 10 days just to see what this price action is going to do here. It could keep going down and it could actually slingshot back up. So we can see that Intel here, when it dropped down, it actually dropped for another 5 days after the earnings announcement. And it did the same thing right here. So that's why I like to wait 5 days. So now we can see that Netflix, once it's dropped here, we can see it's showing some support right here in the 500 level. And then we see some more support here around 477. So after, say, 5 days, if it's still trading flat right here, what I would probably do if I decide to trade this is I would bring up the trade tab here. And I like to go out, I like to give these trades some time. I'll go out roughly about 50 to 60 days. Normally I'll go to the second monthly expiration and I'll find around the 30 delta. So we could sell the 475 and then buy the 470. We'll create a credit spread. This will give us $140. Our max loss is going to be around 360. Yeah, 360. So, and our break even is at 473. So that puts our max loss and break even around this point right here. So Netflix would actually have to keep dropping back to the November and December levels before we actually start to lose money. So we would still break even on the trade in here. And also looking at the RSI, we can see that we're getting close to oversold levels. So that's, this would just be a good time to buy into this stock right now if you're interested in Netflix. And we can see it in Intel last year when it did the same thing. Both times oversold. oversold levels. Some other stocks that I've done this with are Alcoa. Last year I did the same trade. We had earnings. We dropped. I waited about 5 days. I entered in right here. Sold a credit spread. Actually, I think I sold a cash secured put here and waited for it to climb up and then closed it out for a profit. So anyway, this is just a really easy strategy to implement, and it's pretty safe, especially if you do a credit spread, a defined risk trade. You know, you know exactly what your profit and loss is going to be. If the stock keeps dropping, you know what your max loss is. So it's been pretty safe for me, and it's worked well. Um, but anyway, thanks for watching. Hopefully this was helpful, and have a good day. Bye.